Hi, this is Mike Wade and welcome to the weekly video featuring Tom's Tools. Let's get to the disclaimers. Stock and options trading has large potential rewards but also large potential risks. You can lose money trading stocks and options. You know that, and it's advisable not to trade money you cannot afford to lose. Also know that I'm a trader and not an investment advisor, and please don't construe anything that I'm going to show you here in this video as trading advice. All prices are in US dollars unless noted otherwise. Feel free to read the balance of the disclaimer at your convenience. You can pause the recording and read away. All right, so this is a video, a follow-up on last week's video on the earnings effects ranker. This is another way to use the ranker. So many of us as traders love to trade directionally. So what I'm going to show you in this video is how you can use the earnings effects ranker to find stocks that move in a particular direction in the handful of days preceding an earnings announcement. So what we're going to cover in this specifically is directional earnings patterns and how to trade them. Of course, we need to know how to find them. I'm going to show you how to use the earnings effects ranker to find stocks that move consistently up or consistently down in the days preceding an earnings announcement. We're also going to talk about the short-term benefits of implied volatility. What I'm about to show you is a short-term directional trade that will also benefit from implied volatility. I want to make sure you really get that, and then I want to talk about entry and exit rules using long calls and long puts. Okay, just as review, again, gapping stocks are stocks that gap at earnings, and here's one on TRIP. I showed you this in the last video. You can see that TRIP has a history of gapping at earnings. We'll see a gap down in that first earnings period, a gap up in the second, a gap up in the third, and a gap down in the fourth. And that gapping can be actually profited from by using straddles before the earnings announcement and then capturing any directional move after the announcement. So what I want to cover with you now is actually how to trade directionally into the earnings announcement. So if you look right here, what you can see is a pretty consistent move up into the earnings announcement. All right, here's another one. So you can see that TRIP has, at least in this particular case, had a tendency to run up into the earnings announcement. Again, that's based on high demand for the options or the stock with an anticipation of a gap in a particular direction. All right, so one of the benefits of increased demand into the earnings announcement, as I spoke about in the last video, is that the options get more expensive into the earnings announcement. Immediately preceding the earnings announcements, typically the next day, you'll see an IV crush. All right, so if we buy options, as options are getting more expensive, that's called IV rush, and that actually can generate profits along with any directional move. So in order to capture this demand, it's located in the shortest term options available on this chart. There's 7 to 30-day options. On some stocks, you can even get weekly options. So as you'll see in the entry rules here shortly, you want to make sure that you buy the shortest term option available and still have time left as the earnings date approaches. All right, let's hop into the tool and let's hop right back into the earnings effects ranker by going to stock, stock analysis, earnings effects. Okay, so I spoke to you about how to find the best price change after 4 earnings periods. Now what I'm looking for is the best price change before 4 earnings periods, 4 earnings. So, all right, so we're going to look for consistent movers either up or down by running the scan. Now, one quick thing to do though is we want to change one of the default criteria. So click under Wizard Criteria, Show, and then don't worry about all this other stuff here. You don't really need to change this, but what I do want you to change is 7. So days before and after earnings to find data changes, make sure we're looking for 7 trading days before the earnings announcement. Let's give our stock at least 7 trading days to make its move into the earnings announcement. All right, so that's really it. Once again, I'm doing price, best change before 4 earnings periods. I'm changing the trading days before earnings to be 7. And then lastly, as you know, let's go ahead and run this on the S&P 500 stocks, the optionables anyway, and click search. Okay, that search will run, and then you're going to get results that look very much like these. Now, these results were run on September the 20th, 2018. Your results may vary depending on the date that you run the scan. So again, what's in this scan is the company name, the stock symbol, charts, news, the closing price, the average change into the earnings announcement, and that's an absolute value. So for 7 days before the earnings announcement, you can see here that Nectar Therapeutics has an average run of 9.65. Now, it's run up 10%, it's run down 9%, it's run up 4%, and run up 16%. The absolute value of those four numbers is 9.65. But the point is that it doesn't run consistently in the same direction. So it ran up 1, 2, 3 times and down to the tune of 9% on another time. So what I want to see in this list are stocks that move consistently up or consistently down. Okay, so here's one right here on VAR, Varian Medical Systems. You can see here that it has an average run 7 days before the earnings announcement. It has an average run of 4.66. 4% up, 4% up, 5% up, and 6% up. That's what I'm after. So, and on this stock, if I get in 7 days before the earnings announcement, then if history repeats itself, I should have a 4.66% run up in the stock price between the 7 days before earnings period and exiting on the actual date of earnings before the earnings is announced. On the day of, if it's AMC, and on the day before, if it's BMC, or before market close. All right, so you also have the days since previous earnings, the previous earnings date, the number of days to the next earnings period. All right, so I've got a little slide here, excuse me, here that shows some of the stocks that came up when I just ran the scan. I just went ahead and pulled out the ones that have particular directional moves. You can see here that I have a list here on Skyworks, SVB Financial, VF, all the rest. And you can see that all of them have either consistent positive moves or consistent negative moves. So for BlackRock up, from this one up, I'd be using call options. From this one down, RRC, range resources, all the way down, I'm going to be using puts on these four. All right, so that's really the system, and it's important to know how to trade it. So first off, let's just quickly review. In order to find the stocks that have the best price change before earnings over the last 4 earnings periods, be sure in the earnings effects ranker to select price, and then make sure you change the number of days before the earnings to 7, as I just showed you, and then run the scan on the S&P 500, and then you'll have your candidates. All right, so here's what you want to do to trade directional pre-earnings using the earnings effects ranker. So you want to buy an out-of-the-money call or put 7 days before earnings. Remember, the scan is detecting the 7-day run-ups, so it's important to, in order to have the history repeat, that you get in 7 days before the earnings announcement. Buy out-of-the-money options. You know, we talk about delta 30-40, but buy 1 or 2 strikes out of the money, preferably delta between 30 and 40. You want to buy the first expiration option after the earnings announcement. So for example, if I have earnings coming up in 7 trading days, I want to buy the very next available expiration after that date. And that might be a weekly option that could expire on the very next day. If that's the case, do it. Because again, the implied volatility will rush in and offset any time decay that short-term options often introduce, always introduce actually. And this is critical. Step 4, exit before the earnings announcement, usually during the last hour of the trading day that precedes the earnings announcement. And then for safety, always use a 50% stop loss. That's critical. The stock may not go the way it's gone over the last 4 earnings periods. It might go the other way. So it's really important that you manage your risk with a 50% stop loss. All right, that's a wrap for this week. Have fun with pre-earnings directional trades. It is a bit of an advanced strategy, but for those of you that love to trade direction, this is certainly a very good strategy. So thanks for watching, and I'll see you next week.